To understand who truly controls the global economy, you have to look past the banking system and equity markets. There is a hidden engine running beneath it all, a system that inextricably links the value of money to the flow of energy. For over 50 years, the United States dollar has maintained its dominance not through gold backing, but through a structural, global necessity. Every nation on Earth needs oil to fuel its economy, and to buy that oil, they are forced to use US dollars. This arrangement serves as the ultimate anchor for a fiat currency. Fiat currency is government-issued money that isn't backed by a physical commodity like gold or silver, and instead derives its value strictly from public trust and economic stability. We are going to map the precise mechanics of this petrodollar loop. We will examine how this system artificially suppresses United States borrowing costs, and we will analyze why emerging global powers are finding it nearly impossible to escape its gravity. Mapping this closed-loop system clarifies how the United States maintains its structural position at the center of global trade. The current hierarchy of money began at the 1944 Bretton Woods Conference, a gathering of international delegates establishing the post-World War II global monetary system. With much of the industrialized world in ruins, the United States emerged with its manufacturing base fully intact, allowing it to position the dollar squarely at the center of this new framework. The international community agreed to this centralization for one specific reason. The United States promised that its dollars could be directly exchanged for physical gold. Other nations tied their local money to the dollar, treating the paper as a proxy for the metal. That absolute guarantee ended in 1971. President Richard Nixon abruptly decoupled the U.S. economy from the gold standard, an event known as the Nixon Shock. By severing the link to gold, the world was suddenly transitioned into a pure fiat regime. The dollar's value was no longer tethered to a finite commodity, but rather relied entirely on the massive scale of the U.S. economy and the perceived stability of its government. Removing the physical backing created a massive vulnerability for the dollar. Without the gold guarantee, the United States had to engineer a new structural anchor to ensure the rest of the world would continue to hold its paper money. The catalyst for that new anchor arrived during the 1973 OPEC oil crisis, triggered alongside the Yom Kippur War. OPEC is an intergovernmental organization of major oil exporting nations that coordinates petroleum policies and supply levels. Arab-producing nations restricted supply to countries supporting Israel, seeking sudden political leverage. Oil prices quadrupled practically overnight, triggering massive shortages and severe inflation across Western economies. To stabilize the situation and secure its currency, the United States approached Saudi Arabia, one of the world's largest oil producers, with a foundational agreement. The terms were highly specific. The U.S. would provide military protection and weapons to Saudi Arabia. In exchange, the Saudis would price and sell their oil exclusively in U.S. dollars. Because Saudi Arabia dominated the global oil supply, other major producing nations quickly fell into line. To buy oil from almost anywhere in the world, you now needed dollars. The United States had successfully engineered the petrodollar system. Acquiring the energy required for human survival and economic function now strictly required acquiring American fiat currency. To see how this dictates global trade, look at the operational logic of an industrialized nation lacking its own domestic energy resources, like Japan. As shown, Japan requires vast amounts of oil. Step 1. Japan exports goods to the U.S. to earn dollars. Step 2. It hoards these dollars in its central bank. Step 3. Japan deploys dollars to purchase Middle Eastern oil. This structure has a direct impact on the average household. In non-U.S. nations, domestic inflation and daily energy costs are heavily dictated by how well their local currency trades against the U.S. dollar. If their currency weakens against the dollar, oil immediately becomes more expensive for their citizens. Every industrialized nation without domestic oil is forced to constantly hunt for dollars. This dynamic creates a permanent, artificial baseline of global demand for American fiat. This massive global demand for oil creates a secondary problem. Oil-producing nations generate vastly more U.S. dollars than their own domestic economies can possibly absorb. This diagram maps out a process known as petrodollar recycling. Rather than sitting on idle cash, These nations invest their surplus back into American assets, like real estate, equities, and, crucially, U.S. government bonds. This loop provides the United States with a profound macroeconomic advantage. The perpetual influx of foreign capital guarantees that there is always a willing buyer for U.S. government debt. Because there is constant international demand for its debt, the U.S. government can borrow money more easily and at significantly lower interest rates, artificially strengthening its domestic economy. Furthermore, because these massive dollar transactions must clear through U.S. correspondent banks, the system creates a severe operational bottleneck. The United States gains the unilateral power to sever an entire nation from global energy markets simply by applying financial sanctions. Through this mechanism, the United States essentially exports its own inflation and funds its sovereign debt by taxing the rest of the world's absolute need for energy. In recent years, hostile nations and the BRICS trade alliance have actively attempted to de-dollarize their economies to escape this precise choke point. BRICS is an intergovernmental organization comprising major emerging economies that aims to reduce global dependence on Western financial systems. We see this happening today, with Russia and China selectively settling bilateral oil contracts in Chinese yuan and Russian rubles instead of the standard dollar. Moving away from the dollar involves deconstructing decades of entrenched financial infrastructure. As this network comparison shows, exiting the petrodollar introduces massive hidden frictions. Adopting a new currency disrupts established hedging systems, standard pricing models, and international legal protections that have taken decades to build. It also removes access to deep liquidity. Liquidity measures the ability to trade massive amounts of an asset quickly without causing drastic market fluctuations. The US dollar offers an unmatched depth of liquidity, moving billions instantly. Emerging alternatives lack the infrastructure to handle that scale without bottlenecking. Therefore, emerging powers face enormous, often prohibitive economic risks when they attempt to bypass the highly optimized American financial infrastructure. This explains why China and Russia's strategy is highly selective. They reduce reliance on the dollar strictly where it's politically necessary to avoid sanctions, while quietly continuing to use it wherever it remains efficient. The petrodollar system is facing a calculated, gradual erosion rather than an overnight revolution. The true, underlying power of the American economy relies entirely on this foundational link between its fiat debt and the global necessity for energy. The trajectory of global power follows the movement of energy and the currency that dictates its value.